Hi, good morning, Ayush. Thank you so much for your kind words. Good morning. Good morning, folks. Please write in where you have logged in from. Good morning, Dr. Mahanta. Good morning, Manubhav. Good morning, Vineet. Good morning, Rahul. Sarang, Ayush, Ambikapur, Chhattisgarh. Very nice. Gurugram, Bhopal. Good morning, Raghuvansh. Good morning, Vineet from Mumbai. Good morning, RJ Rocks. Deepak Parmar. Good morning. Jaideep Singh, good morning. Anil Vagasia, good morning. Sonipat Manubhav, good morning. Bhuj, Deepak Parmar, good morning. Asif, good morning. We'll wait for 3-4 minutes. Okay, Lokesh Kumar has a funny comment. I'll just show you. He says, you have placed Pasant Maheshwari for me. I love your daily market outlook. Thank you so much for your kind word, but I'm not trying to replace anybody. Let the comic show go on wherever it is going on. Uh, but yeah, I mean, we we basically took the decision to do daily bites, as a lot of professionals who are significant number of people who are weekend investing patrons are professionals, and they don't have time for the markets. So this was one way in which we could give a mini capsule of the market to our users, and attach a small nugget of some information or knowledge or news along with it as a second part of the video. So that was the whole idea of bringing the daily thing together. But yeah, I mean, give us more suggestions and we'll certainly take a look at that. Good morning, Maninder. Happy weekend, Sid. Good morning, Vipul. Good morning, Srihari from Mumbai. Congo. Mm, Devana Bismal has logged in from Congo. Wow, great. Ranjan Kumar from Patna. Manjinder is from Hong Kong. So we have a very nice global group going here. We just take a minute or two and then we'll jump in. We'll look at what has happened this week, look at some charts, and then we'll just discuss whatever uh, people want to discuss. Good morning, Sanjay. Good morning, Gautam. Okay, one more minute. 11:05 we start. So I'll just share my screen also meanwhile. Um, Arpit logging in from Seattle. It must be really late there. Good morning. Uh, okay. So this is where we are on the Nifty. And if you watch the weekly good, bad, ugly weekly review, we give some more statistics there in terms of the makeup of the indices, how many stocks in every index is actually beating the index, and how many are above 200 DMA, etc. So the internals are not looking very, very strong. Now, across, let's say, CNX 500 also, uh, the thank you, Ranjan. The internals of the market across small cap, mid cap, large cap, small cap, micro caps, no index has more than about 45 to 48% stocks which are above the benchmark um, performance. So basically, smaller number of stocks are pulling up the indices, whereas the entire market is not going up. So that situation is causing only very few stocks to really perform, and the rest of the stocks are basically still in a lot of pain. Um, in the small cap space, I think about 40% or more stocks are 30 to 50% down. Um, and micro cap and small cap has this number. Even mid cap space, about 30% stocks are 30 to 50% down. So there is a significant part of the market which is still down. There is a small part of the market which did somewhat well, perhaps because of whatever sectoral news, defense sector was going up, capital market was going up. So overall, it is not a integrated across the board kind of a move. That's what has been happening uh, recently. So when we look at the Nifty chart also, and if we, let's say, if we go back to 2022, October 21, so we had a huge rally here post COVID, and then we spent a good year and a half in this consolidation phase. So this was October 21 till about June 23. So almost 15 months, no more than that, 20 months roughly were spent in this consolidation, market moving uh, 15,000 to 18,000 range. After this rally that we've had, uh, should we have patience that the market is going to do the same once again? That is the question. That if we were to sort of spend 20 months in this kind of range, is that sort of a possibility that we stay in this 25,000 range for some time, and then once the market is fully consolidated here, then we make the next move up. So this scenario, if it plays out, and if, let's say, the same 20 months has to take place, then we are looking at 2026 first half, where really the markets can come together again. But then this is just a hypothesis. It may or may not work, or may have no meaning at all. US markets, for instance, have not done this. US markets are at a new high. And here you can see that absolute new high has been made last week as well as this week. And they are basically off to newer highs. So, higher highs, higher lows. And so US market is looking reasonably all right now. India market is somewhat sputtering at this stage. If we look at um, perhaps even the mid cap space, uh, it has come back, but it really needs to take out uh, this high to really do something. And just look at this rally that we've had in mid caps. We've gone from 23,000 to 50,000 in this time period of March 23 to September 24. 1.5 years, we've done more than 2x. And hence, my fear or my sense is that we may have more consolidation before we go ahead. So that is where the markets are sort of poised at this moment. Now, if I were to look at, let's say, where the commodities are going, so let's take example of gold here. Um, okay, so this has been the rally in gold. It's looking extremely bullish to me. The fact that we've had these small consolidations on the way, and we are having another one of that, and after every consolidation it runs up few thousand points. So this is also signaling that all is not well in the world. Whenever gold is going up like this, it signals that there are things that are breaking down, or people are anticipating that things will break down. So there is significant worry in the marketplace about uh, things getting broken. Now we are already seeing significant amount of confusion regarding tariffs. Uh, what this does is that once there is tariff or policy confusion, it puts the private sector on the back foot. If somebody was going to do some expansion, somebody was setting up a new plant, somebody was going to start some new import exports, they would take a back seat and say, let this clear out. Next 6 months I don't want to do anything. So that comes with a delay in terms of numbers. So if plans are getting halted in the last few months, the impact of that will be felt perhaps in the next 6 months. So that's why I'm saying 2025 from that point of view uh, may not be so exciting as we may want it to be. And the the military establishment, industrial establishment of the Western world is now ensuring that we have some kind of conflict at every point, so that their engines can keep running, their factories can keep running, and that will keep the world disturbed. So on one hand, we have a very disturbed kind of situation when we look at geopolitics, when we look at the global monetary system, interest rates, inflation, the macro stuff. And on the other hand, we have a reasonably growing economy in India. So the idea is that we really can't say how this will, uh, you know, come out in the next 1 year, 2 years or so. And hence, you also want to have some sort of balance between them. So you also want some asset allocation. You also want to, ride the trends wherever they are, little bit they are. So if we see some of the charts for sectors, um, auto sector actually did not even come back to near its previous highs like many others did. But banking sector, I mean, if you look at PSU banks, it is still looking a bit better. Uh, the CNX Finance is certainly doing very well. It is near the all-time high. Metals are also sort of making a decent comeback, but again, they really need to take out this top here. Real estate is kind of sluggish here. Capital markets was doing well, but very recently, of course, as you very well know, that the Jain Street saga has hit the capital market. But I'm still hopeful that capital market stocks and sector will not get impacted as much. Like lot of folks are saying that the options trading and the volumes are have dropped by about 20%. So 20% drop is not such a big deal as well when you look at the entire picture. Then you also have defense, which looks, especially if you look at the daily chart, it looks like it is getting distributed, or there is no further sort of enthusiasm about this. So in the last month and a half, the defense has not really gone anywhere. Pharma is actually looking good. Pharma has been consolidating since the beginning of the year and is at the top of that consolidation. So pharma can perhaps do all right. FMCG is the dark horse, where FMCG has done basically, if we go out, it is still much lower than where it had reached in September, October 24. So if any leadership has to come out in the next few months or quarters, I think FMCG could be one of them, with this having a lot of scope to really recover. So FMCG, autos, etc. But again, it will also depend upon how the economy is going. Uh, Private banks are also doing quite all right. So private banking, you can see, is very much near an all-time high and is doing all right. So these are some of the sort of larger picture items that are there. In, of course, in momentum investing, we are not taking any discretionary decisions based on these charts. But the one good thing that is so far happening is that none of the strategies have any cash, the ones that are absolute in nature, and there is not much of churn in the other ones as well. So the market, from a system point of view, still is quite stable and is at a decent level. I think there is a results of the next couple of weeks may induce some trends in certain sectors, whether positive or negative, we will have to see, and that is something that will sort of guide the path forward. So I'll start the questions that have come so far now, and we'll take it from there. We'll go till 11:45 in this session. Okay. Sri Praveen says, when a firm like Jane Street gets restricted, what happens to their open positions? I think they are given time. Every time SEBI comes out with any regulation order where the entity is being suspended or restrained, they are given time to wind down their positions. So by so and so date, wind down, and uh, post that you cannot take any position. Krishna Pandey says the way number of shares in public domain remains same as long as there is no split or bonus or OFS for a particular company. Do number of gold bees unit remains the same? No, so gold bees units will constantly change because new buyers are coming in all the time. So let's say by end of first of by end of May, there was 1,000 units, or let's say 100 tons of gold being units are issued against 100 tons of gold, and then you by end of June, there are newer buyers into the ETF, and new units have been issued by the ETF company, so it may have become 110 uh, tons by then, and hence the new 10 tons that have been uh, provided in the database, units have to be issued against that. So there is a constant process depending upon whether there is net inflow into the ETF or net outflow from the ETF. Because if there is outflow, the units will be extinguished also. And if there is inflow, the units will get created. So that's how the changes in the gold bees, etc., ETFs keep happening. Uh, Asif says, I have started my gold sip after learning gold investment from you, and I don't expect huge appreciation for next through 3 4 years. I am accumulating gold as a hedge to my remaining equity investment. Okay. So, is there a question here? Uh, I would say do expect good appreciation in the next 3 4 years. I am expecting that. Whether it comes or not is not in our hands. But the way the world is being set up right now, where central banks are rushing to buy gold and accumulating 1,000 tons per year, I'll be very surprised if we don't get a fantastic appreciation in the next 3 4 years. I'll be very surprised. But then the markets are markets, you really can't say. Uh, Shashidhar says, good morning. Your views on banking sector, any banking stocks which is now at a price uh, low PE to buy now. So one thing that we never discuss is individual stock advice. And second is that we have nothing to do with price earnings in our studies. So I will not be able to give you any sort of stocks which are at low PE. But there are so many resources available where you can just go and screen, the sector and get a PE ratio table in, if that is what you want. Um, so go to any portal, any platform which offers this data, and you'll be able to get a sorted list of banking stocks with uh, PE ratios. What I can show you is the banking chart, if that was of any help, where Bank Nifty chart is there, and Bank Nifty was one of the first ones to hit a new all-time high recently. So Bank Nifty versus Nifty is a strong sort of uh, correlation right now. So if we do a Bank Nifty to Nifty correlation, you can see that uh, Bank Nifty is rising now since September versus Nifty in a big way. Of course, we are far from all-time high on that one. So that's where we are on the banking. Sarang says my investment in MI20 has a drawdown on 20 to 25%. Will it be logical to continue SIPs? So perhaps you have joined at the top of the market or near the top of the market. So initially, yes, the drawdown would be there. But if you have come in with the view of having this as a long-term investing, there is no problem. If you see the last 10 years data on any of the strategies, there will be many phases where there will be drawdowns. And if you leave your investing in drawdowns, that is the most common mistake that investors do. So from that point of view, I will never suggest that you leave your SIPs. Uh, Ansuman says, what is your view on USD INR? The rupee is depreciating every year. Should one look to diversify in US stocks purely to hedge that risk? So whether USD is depreciating or not, I think some diversification to US stocks is anyways good, even if rupee were to depreciate or appreciate, because there will come periods of time in the Indian market where it will not go anywhere. And that's what I keep also saying. I mentioned in, I think, the Daily Bite a couple of days ago, that people have got used to the fact that every year should be a plus year. And Nifty is actually doing that. So if we were to see a Nifty on a yearly basis, uh, let's say we take a 6 month candle and let's go to Nifty. The points. So there used to be periods earlier in the 90s and in the mid 2000s where for years together the index did not go anywhere. You know, 92, 90, 92 Harshad Mehta peak really got broken out in 2003. So there was a 10-year period where the index largely did not go anywhere. Then after 2008, there was a 6-year period from 2008, 7 until 13, where the market did not go anywhere. And post that, we've had a pretty much continuous uptrend. Of course, COVID year also was very benign by the end of it. I mean, minus 15% on COVID uh, by the end of the year. So we have got used to this rally mode where we have stopped forget we have forgotten that we could get into a situation where maybe for 3 4 5 years we don't get a new index high, and that probably is the reason why different markets may help you. So if we were to see, and I'll take the example again of comparing India market to, let's say, US markets, and let me take this to another pane, and I will make this a line. So if I were to sort of see some periods in the past where, sorry, so there were periods, let's say, where India market did very well, but US markets was flat. And then perhaps India market was flat and US market did well in that time period. So there will come periods where these two markets will diverge, and you will be able to get the benefit of diversification if you have that. The same reason is also when we say do asset allocation. Uh, it also means that basically there could be periods where equity markets in India may not do well, and you are hedging it against something else so that your overall portfolio does not take a dive, and something keeps working for you right there. Ayush says if every news is discounted in charts, then why charts react positively on positive news and vice versa? Why there is a direct price reaction when news is out? Example, Glenmark Pharma. So there is nothing absolute about it, Ayush. When we say the markets are efficient, they are actually not efficient, but they tend to some efficiency. So when we think of binary like 0 or 1, then everything has to be clubbed either perfectly in 0 or perfectly in 1. But there is a whole range in the middle. It's like saying that, let's say a good news is coming through, and perhaps 70% of it has been discounted, and depending upon the news, because perfectly the news getting discounted ahead of the news also cannot happen 100% of the time. So the idea is that if you will to see 10 uh, instances in the market, perhaps 8 instances will be there where some part of the move has been discounted, and only a small part is reacted to post the news outcome. And you will also see a few instances where you got a positive news, but the stock tanked. So that is a clear indication that the market discounted more than what was required. So my sense is that there is no 100% concept, but if you find that stocks are behaving discounting ahead of the news, you can make use of it like momentum investing does. I hope there is some answer to this. What is the maximum time? Vipul is asking this question. What is the maximum time you have seen one of your strategies underperform the relative index? As you suggest, minimum investment time should be 5 years. So about 3 to 5 years is something that you have to come in, and even after that, there is no guarantee that the relative index has to be breached. There are no guarantees. There are no possible. I mean, life has no guarantee. I can't say if I'll wake up tomorrow or not, or you whether you will be well or not. So these are all sort of strategies built in with a character that is likely to beat. Now when you go sit in your car, can you say that with 100% uh, surety that you'll be able to use it? Sometimes it works, sometimes maybe once in a blue moon it doesn't work. So these are some of the things that are there. But yes, I mean, few years underperformance is always possible, and some of the best strategies have seen that. You know, strategies that have done the best have seen some very poor years. That is also possible. So can't say that it has to happen. Can we get some backtest stats for all cap gold? Backtests are not really encouraged by the regulator, but if you request us, basis that request, we can share some numbers with you. The regulator does not want us to give any backtest of any strategy. Jack of all trades is saying, I like platinum more than silver because the worst thing with silver is its volume, very difficult to store. Okay. Uh, Happy investing in platinum, I guess. Uh, Bhavik says the new offering that was launched last week, how is it different than existing all cap plus gold outside of small cap? The only difference here would be that the strategy has like fixed silos. If large cap is dedicated at 25%, then it stays at 25%. So what it does is that at the end of each month, it will reset the weights back. So what that will do, sometimes positively and sometimes negatively also, is take away the profits of that month and redistribute it. The other way to look at it also is that if market is dropping and if the stocks sustain in the portfolio, then they will sort of get averaged down. So that's the sort of play that will happen in that strategy in terms of the weights rebalance happening, and that's how it is different actually. Vineet says a request for a video topic: how should retired people handle large sum that they receive after 60, especially for salaried people with low risk appetite? So no rocket science is needed for this. I have several times mentioned a very simple mechanism. Let's say you get 1 crore rupees as whatever, you know, gratuity or retirement benefit, whatever it may be, or you got inheritance. Let's take this number 1 crore. Now you are very afraid of the market. Let's also assume that you've never invested in the market. You are 60, uh, and you have no risk appetite at all, and you are willing to put it in the bank at 6% taxable. So the best way to go about is take a risk of 10%. 10% of that money you put it into any equity oriented product, whether it is mutual fund, small case, PMS. PMS won't happen at 10 lakhs, but you get the idea basically. And allow it to run for 1 year. At the end of 1 year, if the market was good in that year, it will generate significant confidence for you that 10 lakhs would have gone to 20 lakh, 12 lakhs, 13 lakhs, somewhere number will be there. So there will be some buffer that you have built. Let's take the other worst case scenario. It was the worst year of that decade and you lost 50% on the market. So your 10 lakhs have become 5 lakhs now. And your 90 lakhs with the 6% interest are, let's say, at 95 lakhs now. So 95 from your original fund, 5 from here, you are still at 100. So this year, you did not make anything and you are still at 100, but you have exposure of 10% now in the market. And you have seen one of the worst falls of the decade or perhaps even 2 decades. Now you add another 10% or 20% to that mix. Allow 1 or 2 years buffer to get built. In 2 3 years time, certainly in 5, but in 2 3 years time also most likely, you will find that you have a 10 to 15 to 20% kind of a buffer on your equity investment. That buffer basically will give you comfort that if I get that worst case scenario once again, not I'll lose this buffer. In my mind, that has been a additional that has been generated, and very little of my capital. I will not go to minus 50 of my capital. So this way, at one step at a time, without wanting to leap into the market on day one, over a 5 year period, even if you come to, let's say, 30% equity and 70% fixed income, debt, whatever it may be, rental, you would have come to a very reasonable equity exposure. Then it depends upon you. If you like it, you can take it to 40, 50, 60 also. But a lot of senior folks don't want that kind of volatility. So the equity exposure can be, a little bit, which makes sure that this extra alpha that equity generates is able to, give this entire rest of your money, which is just not even beating inflation, just matching inflation, some extra alpha on that. So I think this is how you can really go step by step and do that. I mean, the video happened here itself. Uh, Manubhav says why some stocks have upper circuit 5, 10, 20%. So there are more than that also. There are some 2% circuit stocks also. And if they continue to run, then they will be put into some kind of suspension, etc. So this is the way of the regulator, where the regulator feels that uh, by having daily restriction of movement, uh, people will not be able to manipulate the stocks too much. Although 5, 10, 20% is also quite a lot of movement. For instance, in the US markets, there is no circuit limits. So often you would have heard some stock has dropped 80% in one day, or some stock is up 300% in one day. So those kind of moves are possible there because there are no limits. Here, maybe because of legacy reasons, because there have been a lot of scams in the past, the Indian regulator is more conservative, and it wants the market to move in a more orderly fashion. Although there are some negative repercussions of this also, in my view, uh, where especially for 5-10% circuits, some significant players can corner some part of the float and very easily use these circuit levels to actually fool a lot of retail investors. So, daily you hit a circuit with very little volume that is needed. Every day if I come to the market, let's say I'm that manipulator, I'll come to the market and put my bid at top 5%. Not many sellers will come when they will see a large bid there. Of course, I will need to have those kind of deep pockets. Next day again, I put a 5% circuit. Next day again, I put 5% circuit. Or every seller will back out. They will think that, I don't know what is happening in this company. Maybe somebody is buying out this company, is going multi-folds, and other people will then start to join the queue. Then one day, after many such circuits, the operator will come and dump all their stock on those people, and it will crash down 5% down. So sometimes these are detrimental situations, but uh, the regulation of the country currently has this. Dipesh says, can you give brief overview of Moderna chart? So we'll not get into specific stocks, so I'll not focus there. Deepak says, why so much trend on copper and how does US profit by increasing tariff on if their intention is to increase manufacturing? That is actually the question that is going around. You very rightly hit the nail on its head. That if copper prices go up, I mean, what happens to US manufacturing and the capacity and expansion that they are looking for in the next 5 years. So I think just like many other things, perhaps this will get diluted or get cancelled in the next few weeks by the time the deadline comes for the copper thing to rise. So I think copper is that one element, one metal where it has a cascading impact on all manufacturing because it is used so widely in so much of manufacturing. So if copper prices go up, it immediately causes a lot of inflation in the world. So that brings you to another sort of conspiracy theory where perhaps they are trying to engineer a lot of inflation. Like President Trump is constantly talking about low interest rates, that interest rates are 3% higher than where they should be, and his nominees is going to get announced in the next few months, perhaps, and come into the treasury, in the Fed treasury. And if they do reduce interest rates by 2-3%, as they are saying, the money supply and the cash and basically the inflation is going to go out of hand. So my one thought process in my mind is that perhaps they want this. They want a very, very high inflation to exist for 5-10 years so that the debt that is there today can be inflated away. So in simpler terms, let's say I owe 1 crore rupees of home loan and my EMI is, let's say, 9 lakh rupees per year, and my earning is, let's say, 10 lakh rupees a year. So I am struggling basically to pay the EMI. Now, let's say there's huge inflation for 10 years, and the house that I bought for 1.5 crores is now worth 15 crores. I can easily sell it off and pay off that interest. Or my income, my salary, if there is huge inflation, my employer will also increase my salary accordingly. Let's say there is 10% inflation, and my salary also in couple of years will become 20 lakhs. Then I'll be able to pay this 9 lakhs very easily. If there is, and US has fixed interest rates on home loans, etc. India very smartly has variable only. So the idea is that the debt payment, interest payments that the government has to make, if they inflate away the debt, then those interest payments will become on a percentage wise of the entire uh, uh, asset base, mm, much more manageable than it is now. And that's how it was done in the 70s also, that inflation was allowed to run amok. You will not believe, but interest rates in the US were in high double digits, high teens. So 16, 18, 19% kind of interest rates were there in the US. Um, and that's where gold went up 30, 40 times in that decade. Um, and stock markets also did very well. So any asset did very well in that period because of uh, very low interest rates and high inflation. So maybe they are trying to engineer that in some way or the other, that we should do something which causes just a blast of inflation. Possible. Okay. Okay, what factors decide what will be the upper and lower circuit limit? So different category of stocks are there as defined by the regulator, and basis that category they will define it. First, the stock will be put in 20%. Then, if it continues to hit some 2 or 3 times 20%, it will be brought to 10%. If it continues to hit circuits there, then it will be brought to 5%. So there is a gradation metrics where it will go from 20 to 2 and then go from 2 to 20 also if it remains stable. So I'll take the last question now. Um, your thoughts on the India manufacturing story. Do you see any improvement in the sector in the next 5 years? So I think there is certainly strong push not only by the government but by global companies to do more and more manufacturing in India, whether they will be successful in creating a competition for the other countries that are competing for the same business, whether it is Vietnam, Philippines, Chinese companies, or even company in countries like Eastern European countries are also competing, like Romania in certain fields, and so on and so forth. So it all depends upon how we will shape up on this. Certainly, we don't have that skill set and the very conducive ease of doing business, a government policy for India manufacturing to really take off in a big way. So we will probably do our own pace of growth in that, and hopefully we'll see some improvements in the coming years. So we are at the end of my time. Thank you so much for watching, and thank you so much for coming on a Saturday morning. I'm sorry I've not been able to take a lot of the questions post this one. We'll keep it for the next time, perhaps. We also do a Ask Weekend Investing round every Friday. So if you can ask your questions, tagging me in the Twitter or X on Fridays, I'll certainly try to take up your questions. If there is any burning issue regarding your subscription or investment that you needed clarification on, please drop us mail at support@weekendinvesting.com. We'll certainly clear that out within 24 hours. So thank you so much for joining and have a great weekend and goodbye.